आज के इस एक्सप्लेनर में हम एक ऐसे वेल्थ क्रिएशन इंजन को डिकोड करने वाले हैं जिसने पूरे इंडिया का ध्यान खींचा है। Welcome, I'm your host, and today I'm putting on my financial advisor hat to walk you through the real, data-backed math behind mutual funds and SIPs. We're going to completely strip away all the stock market hype, the confusing jargon, and honestly the fear, so we can look at the pure mechanics. If you've ever felt like building wealth is something reserved only for the experts, well, this session is absolutely going to change your mind.
81.92 lakh crore rupees. Just take a second to let that number sink in. That is the total assets under management, or AUM, in Indian mutual funds as of April 30, 2026. Now, why am I starting with this massive figure? Because it proves a really fundamental point. Investing in mutual funds is no longer some niche experiment or a gamble. It is a mainstream, heavily regulated reality where literally crores of Indians are confidently parking their hard-earned money.
Okay, let's dive into this wealth blueprint for today. First, we'll uncover mutual funds ka such. Second, we'll look at the math behind the power of SIP compounding. Third, how to choose the right funds. And finally, we'll lock down your defense with the top 3 investing mistakes.
Chapter 1, Mutual Funds ka such, the core mechanics of pooled investing. It's absolutely crucial that we strip away the market noise right from the start. You really don't need a finance degree to understand this structure. You just need to understand how resources are shared. Ab simple terms mein samajhte hain. A mutual fund is exactly what the name suggests, a mutual pooled investment vehicle. Imagine thousands of people contributing their money into one massive common pot. Then, instead of you having to obsessively track daily market movements, a highly qualified professional fund manager takes that pool and strategically invests it into stocks, bonds, or a mix of both. You're basically outsourcing the stress and the heavy lifting. Let me give you a relatable real-world analogy. Imagine you and 20 friends want to go on a really complex, treacherous mountain trip. Instead of every single person renting their own car, buying their own map, and trying to navigate those dangerous roads alone, you all chip in, you hire a premium shared vehicle and a professional, experienced tourist guide to do the driving. A mutual fund works exactly like that. The driver is your fund manager. You own a seat in the vehicle, meaning you own the units, but the fund itself owns the underlying assets. This gives you instant diversification that would be incredibly difficult and way too expensive to build entirely on your own. And Indians have completely embraced the shared vehicle. According to AMFI data, there are now 27.53 crore mutual fund folios in India. To give you some context on how ridiculously fast this is moving, the total AUM in April 2016 was about 14.22 trillion rupees. By April 2026, it hit that 81.92 lakh crore mark we talked about. That is nearly a 6-fold rise in just 10 years. This massive growth is being driven by better digital access, rising retail participation, and a deeply growing trust in the system itself. Moving to Chapter 2, Power of ASIP Compounding, the Mathematical Engine of Wealth Growth.
बूंद बूंद से सागर बनता है. A systematic investment plan, or SIP, is the mathematical engine of wealth growth. But honestly, more importantly, it's a brilliant behavioral tool. An SIP is simply investing a fixed amount at regular intervals, like every month, instead of waiting around trying to invest a huge lump sum. Think of it like building a solid wall one brick at a time. You don't need to stress about predicting the perfect day to place a brick. What matters is that you just keep placing them consistently. Over time, the base of that wall supports the next layer, and that layer supports the next. That is compounding. It also naturally introduces rupee cost averaging. That means, when markets fall, your fixed monthly amount automatically buys you more units. ये होती है compounding की असली power. Look at this. A modest 5,000 rupee monthly SIP, assuming a 12% annual return, looks exactly like this. After 10 years, you've invested 6 lakh rupees and your corpus is about 11.6 lakhs. Great, right? But watch what happens next. At 15 years, your corpus jumps to 24.7 lakhs. And at 20 years, it skyrockets to nearly 49.8 lakhs. The growth curve dramatically bends upward in those later years. Just think about it. Between your 15 and 20, you only invested 3 lakh rupees more from your pocket, but your wealth grew by 25 lakhs. The last few years add far more wealth than the early years combined. And the data strongly shows that investors are catching on to this math. In April 2026 alone, the monthly SIP collection in India hit 31,115 crore rupees. Let that sink in. Every single month, thousands of crores are systematically flowing into the markets. This proves systematic investing isn't a fad. It's a mainstream structural habit. When markets get volatile,
This disciplined money just quietly keeps buying more units at lower prices.
Chapter 3, Choose the Right Funds. Categorizing your investment toolkit.
Now, what's really interesting about this slide is how simple it actually is. If you're ready to start placing your bricks, how do you pick your materials? A beginner's choice isn't about finding some magic secret fund. It's simply about understanding cost, risk, and the specific role a fund plays in your portfolio. We can easily categorize your options into 3 ways to travel. First, indexed or passive funds. These simply track a benchmark like the Nifty 50. This is like taking a fixed route highway bus. It's low cost, minimal intervention, and just follows the main road. Second, active equity funds. Here, a manager actively picks stocks to try and beat the market. This is your private driver trying to find faster alternate routes. It can outperform, but the fees are definitely higher. Finally, debt funds. These invest in fixed income instruments. This is your slower, steady vehicle that prioritizes a smooth ride over high speed, which is absolutely perfect for stability.
Which brings us to one of the most critical decisions you'll make: direct versus regular plans. CBI guidelines clearly show that the underlying portfolio is exactly the same for both. But regular plans include distribution and intermediary costs, meaning higher expense ratios. Direct plans bypass those middlemen entirely, offering lower expense ratios. If you're doing your own research, sticking to direct plans is a powerful way to control costs and avoid unnecessary hidden commissions that silently eat into your long-term wealth.
Chapter 4, Top 3 Investing Mistakes. The Behavioral Guardrails for Your Wealth. Let's move to our final section and see how this builds your defense. In a mature 81-lock core market, beginner mistakes are rarely technical anymore. They are almost purely behavioral. Mistake number 1, over-diversifying. Buying 15 different funds doesn't make you safer, it just creates overlap. Many of those funds hold the exact same top companies. You want a clean, simple structure, not clutter. Mistake number 2, panic stopping SIPs when the market falls. This is exactly the opposite of what you should do. And mistake number 3, ignoring the quiet drag of expense ratios. A slightly higher fee might look tiny today, but over 20 years, it silently compounds against you and destroys a significant chunk of your hard-earned wealth.
So, the crucial point to remember here is this: consistency usually beats prediction. Think back to mistake number 2. Market drops are uncomfortable. Absolutely nobody likes seeing red in their portfolio. But financially, that is the exact moment your SIPs are doing their best, most aggressive work. They are buying more units at cheaper prices. The discipline to keep your SIP running through a red market is the ultimate advantage of this entire system.
Which leaves us with this final question to ask yourself today. Are you relying on magic for your wealth, or are you building a structure of patience? Mutual funds and SIPs do not create wealth by magic. They create a highly regulated, data-backed structure where your patience, your regularity, and your strict cost control can literally compound into life-changing outcomes. Keep it simple, stick to your SIPs, and let the math do the heavy lifting. Thank you so much for joining me on this explainer today, and happy investing.